Hi, I'm Vishnu Srinivas, and welcome to Hawkeye. I started this podcast to give professionals an open platform to share their candid views on topics impacting businesses and economies around the world. Make sure to rate, review, and subscribe. Joining me today is Lakshman Achuthan. He is the co-founder of the Economic Cycle Research Institute. Thanks so much for taking the time to speak with me today.
Oh my gosh, thank you. I've been looking forward to this.
Awesome. So, do you want to start off with a short introduction about your background and your role?
Sure. I'm co-founder of the Economic Cycle Research Institute in New York. We've been around since '96, and before that, we were at Columbia University, where I met my mentor, Jeffrey Moore, who's widely seen as the father of leading indicators. So, talking lots about a leading index approach, not a model-driven approach. To monitoring cycles and cycle risk. And Dr. Moore's mentor was a man named Wesley Mitchell, who defined what a cycle is, what a recession is,
Mhm.
all the way back in the 1920s, I'm saying, 100 years ago. So it each time there's a cycle turn, a lot of people get interested in it and they're studying up on it. We've been doing it now as I've kind of just reviewed for 3 generations, and we work with different types of decision makers about how to manage cycle risk in their process. So pretty much it's like it could be a large asset manager. How do they think about cycle risk? Could be a large, pretty like multinational or the C-suite. How do they approach cycles in terms of managing businesses?
Mhm.
And a couple of policymakers here and there.
Awesome. So we're gonna get into a lot of that
All
stuff.
right. Okay.
But starting off, I guess can you walk me through your modeling process a bit and talk about like the reference points you look for in determining whether a certain phenomenon constitutes as cyclical?
Sure. That's a great question. So, I mean, in a way, when I was just talking about those generations, right? Yeah. So I'm going to give you, and I'm happy to talk about all the current state of the art. My mentor was just like, hey, can we predict a cycle turn? Is that doable? And his mentor was, what's a cycle? I mean, those are really big questions, right? And you could see even now, a couple quarters down GDP, oh, it's a recession, it isn't a recession, all that stuff. Everybody just heard all that, right? So the same kind of stuff was going on 100 years ago. And they didn't have as much statistics as we had, right? So sometimes they would know something was totally wrong. Hey, I can't find a job. I can't do this. Nobody's buying my stuff. Or on the other hand, I can't find someone to work, or I can't produce enough, right? So they knew something was happening. I don't think they could articulate really what it was. And you had booms and busts. And the cycles were even, they were quite a bit bigger. They were what I'd call kind of jungle variety cycles. And by and large, we've had garden variety cycles in recent decades, all
Right.
except for the Great Recession. So you got to figure out your target, what's cyclical. The basic premise, and if you disagree with this, then you don't have to listen to the rest of the discussion. The basic premise is that a market oriented economy dominated by free market activity doesn't have to be pure. Nothing is actually, right? But but something dominated by free market activity will have an inherent and endogenous cycle, an ebb and a flow, upswings and downswings in activity. I'm just sticking with growth right now.
Right.
And during these upswings and downswings, what happens, what we've kind of learned is that during the downswings, under certain conditions, you're very vulnerable to shocks, which can be associated with recessions. And during upswings, you're not vulnerable to shocks. And so shocks are always happening. They're by definition, you can't predict them.
Yeah.
So which ones matter? And that's where monitoring the cycle can be helpful.
Right.
If you're in this downswing and under certain conditions, whoa, I don't even, I just know that we're super vulnerable, and then we'll look around and see what shocks are there that could be recessionary.
Mhm.
So, very simple brass tacks on business cycles and a recession. What's the target? What's our bogey? What are we looking at? We're trying to track the direction of growth in output, employment, income, and sales in very broad measures. And how are they moving together, right? Because all of them are jerky.
Yeah.
And so in any one moment, they could go like that, right? So it's like, how do you put them together and track them? And you will see an ebb and a flow. You will see an acceleration and a deceleration. So one cycle we look at is just that, accelerations and decelerations. And the terms we use are called growth rate cycles.
Mhm.
Okay. So if you're in a slowdown, that's a growth rate cycle slowdown. If you're accelerating, you're in a growth rate cycle upturn. When that goes negative, okay, but specifically when the level of activity now is falling in what we call a pronounced, pervasive, and persistent way, then you're entering recession territory. And so, one of the reasons we're not in recession, as far as we know, is that with all the data in hand, employment is not falling, right? To the contrary, it's still growing, albeit slower, right? Year over year growth, even though you're getting some of these stronger than expected numbers, year over year jobs growth, establishment or household data is still decelerating,
Right.
even through the latest report. So, um, that on the question, are we in a recession right now? Probably not, because it's not pervasive enough. It's not hitting all output, employment, income, and sales. It's hitting a bunch of them, but employment's the big standout that it isn't hitting yet.
Right.
So
Yeah.
that's our target.
Exactly. And diving into that a bit more, like you mentioned, obviously there's a lot of hubbub about the two negative quarters of negative GDP,
Uh-huh.
and there's been extreme yield curve activity lately. But obviously these aren't definitive measures of a recession. And like you pointed out, July's job report was obviously way stronger than anticipated. So how do you go about like weighing all these different factors that are indicative of a recession?
Well, so we've talked about coincident data. Everything I just said was about the target: output, employment, income, sales. Those are all coincident, roughly.
Yeah.
Some of them lag and lead a little right around the turn, but they're all what we will call, quote unquote, roughly coincident data. And when we're dating cycle chronologies, either for business cycles or for growth rate cycles, two separate chronologies, when we're dating those, and we do that for 22 economies around the world, including the US, and in the US, our dates have lined up with the National Bureau, where, by the way, Dr. Moore was director. My mentor was director
Oh.
for a long time. And uh, prior to 1979, he picked all the dates. So
Mhm.
all your shaded areas, he picked them. And then after that, he was a senior member on the committee of dating things until he passed away at the beginning of this century. So we know kind of what we're doing in that dating. Everything I've been talking about is coincident data.
Mhm.
How do we think about recession? If we're in recession, what are we doing? Now I got to switch over to leading indicators. So that's the second generation of work, right? That's Dr. Moore,
Right.
where he's building on some earlier work that started actually in the Depression, 2933 Depression, where they were looking for indicators of recovery. Then the Secretary of the Treasury was a man named Robert Morgenthau, and he was like, "Please, show me anything that looks good." And they're working on this, and they're like, "Okay, well, forget about recessions. We just want to be looking at indicators of revival." So that's the moment. That's like, hey, what leads the target at the turn?
Right.
And then Moore after World War II returned to that work and developed leading indicators of revival and recession. So that's your first kind of idea of a true leading indicator in the sense that we might think of today. And the problem was how do you put all this stuff together, right? Because these are things that are not easily combined. And so they actually had to create new statistics, including the composite index method. Right. So you could have a diffusion index, which is like how many of the things that I'm watching are moving up or down, like a percentage, a proportion, like ISM. Right. But then the thing is, what about the magnitude of the move and the relative magnitude of the move? And that's where you have to develop new statistics, basically. They didn't exist. And that's the whole idea of a composite index.
Right.
It had to be developed to put these indicators together. So there's a lot of stuff that is in that institutional kind of multi-generational history that I don't know that everybody really understands and appreciates. And there's nuances in there that are important. There's a lot of things about developing a composite index that are tricky. And one of the risks around, I've been careful not to say models. Okay, so we're not using, those are not models. Okay. One of the risks around models, and some of the risks in statistics, anybody who's familiar knows, you can kind of torture it to do what you want.
Yeah, exactly.
So the thing is, how do I stay objective in all this? Right. So we have an agenda. Everybody has an agenda, right, in the world.
Okay.
Our agenda is getting the turn right. Okay, it's not bullish, bearish, or whatever, right, left. It's just what we need to nail the risk of a directional turn.
Exactly.
And so how can we objectively monitor these indicators without kind of fitting them, which is a risk in models sometimes, or otherwise kind of skewing or putting our thumb on the information, which we don't want to do. So we do a lot of work in our composite index methodology, which is unique to us, about how to do that. And we look at leading indicators with this composite index methodology. And if they turn, they're targeted to turn ahead of the coincident data. So I'm oversimplifying. If the coincident data is going up and down, all I really want to do is know if I'm going up or down. Am I at the peak or am I at the trough? So the leading index, the primary purpose is the risk of that turn. And so they're designed, they're hypersensitive, they're very sensitive, and they should turn ahead of a turn in the target. By virtue of having a lead of some sort, of some time, right? And there's different varying leads. You then can go through an objective exercise, as objective as is humanly possible, right? There's a limit. But we do stick to this framework, which I've already described a little bit, which is how pronounced, how pervasive, how persistent is the move now in the leading indicators compared to past turns. So those are knowable. I know what it looked like, how it looked in past turns. And I can observe now, what is it doing? And so from a peak in the leading index, 1 month it goes down. I go, oh, well, okay, not very persistent. Maybe it's pronounced, maybe it isn't. I don't know, compared to past turns. And is it pervasive? I start asking these questions.
Right.
And let's say I get 3 or 4 months of this. Now I have some information. Well, look, it is persisting.
Yeah.
Like it did in past turns. Actually, it isn't as pervasive. Okay, let me hold off. And maybe it isn't as pronounced. But if those 3 Ps that we call them, if they start to get checked off and I get all 3, yeah, the odds of that being a cyclical turn have now really risen. So once I have that cyclical turn, I've got a piece of information. Now, it might have taken me 3 or 4 months to get that information from the leading index. So the lead time is important, right? Because I'm leading the coincident data.
Right. Yeah.
So then now we get into the kind of the current state of the art. Different types of leads. I have short leads, medium leads, long leads. So if a long leader turns first, they're probably more erratic, a little more jumpy. Now I have a prior view.
Yeah.
To receive the shorter leading indicators. My conviction starts to build. So now you get to the coincident data. And look, we're doing a real-time exercise right now.
Right.
The coincident data is mixed. At the beginning of our talk, we just said that, right? Hey, some of it's down, some of it's up. The recession has not started.
Yeah.
Really confusing. Now let's translate that to the business people, right? Or the investors. So the market's down, but is it? Maybe it's rallying now. Well, maybe, they're confused, right? They're like, where are we?
Exactly. Yeah.
What's going on? And the forward-looking data is saying, oh, it's a cyclical turn. And having said that, we immediately go to the next question: is there another turn in sight? So we're pretty convinced that the coincident data is going to continue to decelerate or contract. So that's a recessionary expectation on the coincident data, regardless of whatever the headlines are. Okay?
Yeah.
Because this is the process. It wasn't made up yesterday. This is a very long-standing process, and it has a long real-time track record. Okay, so that's what that's saying. But I'm still looking ahead. Maybe the market is smarter and knows, it's everybody's information.
Right.
Maybe it's seeing a turning point way in the future.
Is
there any evidence of that in non-equity related forward-looking indicators? And the answer so far is no. So that's how we kind of receive the current information. Now switching over to the businesses, right? What are they doing? And they're, the people we work with are prepared for, continued slowing. So you make hay with the pricing power that you have, and otherwise prepare for some more demand destruction in front of you. And how do you navigate that? And if your posture as a business is prepared, there's actually opportunities, right?
Right.
But you're more you're moving in front of instead of just reacting to stuff.
Yeah.
So let me stop there. I threw a bunch of
No, that's all good. I think it's a really good framework for looking at like an issue with like recession where there's so many nuances in it. It's not just some news headline of 2 quarters of negative GDP. Shifting gears though to another obviously headline in the news is inflation. And I guess when you look at the cyclical behavior of something like inflation, do you think it can help us in the way that the government or the Fed crafts policy solutions? Because you kind of have a framework to compare different time periods.
Yeah. Yeah. The answer is yes. It's a little frustrating. I think I'm probably built. There's a certain part of me that is built for public service, and I've been resisting it forever. In the sense that, not in the sense that, I mean, I do it personally and around me, and I love to talk to people and be with them, and if a policymaker asks, we certainly try to help. But there's a first there's politics, which we don't want to get involved with, right? So we're
Yeah. Yeah.
we're nonpartisan, and so then there's some academic kind of stuff that is in there, right?
Mhm.
So I have nothing against a model building approach to forecasting. It's a
Right.
perfectly good way to answer a whole host of questions, and it's critical for kind of preparing for a world which is super dynamic and you still have to have a framework. I
Yeah.
get it. Okay. In the instance of cyclical stuff, it's not that helpful.
Mhm.
Okay. I mean, it's just that's what I've come to understand is that not a great tool for answering the question, what's the risk of a turn? Okay. So going back to the premise that we're in a market oriented economy that has endogenous cycles in it, and now you're talking about policy. Okay. Let me break it down into structural and cyclical,
Mhm.
right? Structural stuff, uh, I'm oversimplifying, but should kind of sit with the kind of the legislative or fiscal side of policy.
Mhm.
All of those fiscal tax and spend and what are we doing and what are the rules and all those things. Well, that could address some big structural stuff, presumably, right?
Right.
So um, when you have okay, we're in something that's cyclical, and every time there's a depression, 20% of the population's out of work and starving. Okay, let's have some unemployment insurance. All right, yeah, okay, that's taken some of the edges off, right, of the decline, and
Yeah.
maybe smooths the cycle. Okay, these are perfectly fine structural things to do. Then we switch over to monetary side of stuff, especially more modern monetary policy, and it's a questionable set of mandates, but they've got the mandates of low unemployment and low inflation, um, which may compete at times with each other, right? It's a
Mhm.
lot of interpretation there for that, but this is what we have, and you see policy running, trying to, for the most part, until fairly recently, kind of focused a bit more on the inflation side of things, right?
Mhm.
We have to keep inflation low, and if we do
Yeah.
that, everything else will work out.
Mhm.
And in trying to do that, now we flip over to the academic side of stuff, and the training that many of the PhD economists at central banks get uh, may have some foundations in the Phillips curve and stuff like that.
Yeah.
Okay. And when that type of quote unquote forecasting of inflation, right, in a monetary policy place fails, right? It actually hasn't worked very well,
Yeah.
right? And so they're trying to predict and do this and adjust policy with that. And they've had some trouble. And the reason they're trying to predict inflation is because monetary policy works with long and variable lags.
Right.
So
Yeah.
if you wait until actual inflation is like hitting you on the head and then you act, if you understand kind of cycle dynamics, being reactive to a cycle actually can make the swings in the cycle bigger.
Oh,
If
yeah.
you're But if you're preemptive, you can kind of smooth the cycle a bit. That was in
Yeah.
theory, right? So you want to be preemptive. They haven't these things, this Phillips curve isn't preemptive. So the only kind of modern example we have of a different approach, at least from where I sit,
Mhm.
would be Alan Greenspan's circa 1990s. Okay, I'm not signing on to his entire career,
Yeah. Okay.
but I'm just saying in the 90s, um, Alan Greenspan was a student of my mentor Jeffrey Moore. He knew something about cycles. He knew something about inflation cycles, which are separate from cycles in growth. So you have a separate set of leading indicators for the inflation cycle.
Mhm.
Inflation and growth are related, but the cycle turning points can vary quite a bit, and you actually see more inflation cycles than business cycles. So these are things like you have to be aware of this kind of stuff.
Right.
If you're a central banker, I really think it's critical. It's like job definition. And he had this interesting episode of raising interest rates in the early 1994, before inflation itself started to firm, preemptive, and then easing rates in 95 before inflation started to turn down. So again, preemptive. And that was a mess for the bond market, which didn't, I think, understand what he was doing. But it's also part of the history of a pretty good expansion. Right, the 90s is a pretty good business cycle expansion when you look at all the expansions. Okay,
Yeah.
there's a lot of jobs. There's a lot of stuff that happened there, and in fact, it was so good they thought it was a new era.
Yeah.
and then you run into trouble with
Yeah,
that.
of course.
But you. So I think that this really informs what's going on now, because we had an inflation cycle downturn call. Our forward-looking data turned down in the late summer, fall of 2018. Three Ps, what I described earlier, the future inflation gauge, three Ps turned down. The target is the inflation cycle defined by like CPI, PPI, PCE, all those things. So the target is super clear. And this downturn in the forward-looking data happened before the bond market was able to move. The bond market didn't move until November, I think, or so. The Fed kept hiking. I think it hiked in September, December. And then the market tanked. I think it was probably on the order of 20%. It was like big tank, at the end of 18. And then Powell just said, screw it. He's in the middle of a rate hike cycle, and he just turns and goes the other way and pivots. Much like what the market is hoping for today.
Yeah.
Right. And so the Fed, they just did not see that inflation cycle at all. They totally were looking the wrong way. Did not understand. I think they basically don't understand inflation cycles the way that the 90s Fed did. I don't think they, I'm not saying it in a mean way. I just don't think they comprehend it that way.
Yeah.
So that the lesson that gets learned by that episode is, no, we can't really forecast inflation. So maybe we'll do this alternative inflation target, or maybe we'll just wait for inflation, or maybe we just underestimated the Phillips curve and it's a lot flatter than we thought.
Right.
So inflation just really is not, unemployment can go really low, and you're not going to get an inflation problem. So we just don't really have to worry about it. And then you have an inflation cycle upturn call in the fall of 2020. Same indicators, boom, three Ps. And now this is one, like everything in COVID, right? This is one for the record books. The FIG went to a 33-year high. Wow. I don't get to say that very often, right? Yeah, no. So it goes to a 33-year high, and they're like, yeah, it's transitory. And we're like, no, it's cyclical. Remember, it's pronounced, it's pervasive, and it's persistent.
Yep.
That is cyclical. And by their new framework, they're waiting to see if it's transitory or not, and they're waiting, and then finally they start going in March of this year. That is an epic failure. Epic. And so now they are in a situation where they are tightening, and I think will continue to tighten regardless of CPI year over year coming down a little bit. And they're doing that into a recession.
Yeah.
it's literally the opposite of what you would want to do as a policymaker, and they're forced to do it because of the earlier mistakes.
Hmm.
And they're not alone, right? See, the Fed is the leader of many central banks. And I don't think the central banks will say that, but a lot of them follow the Fed, right?
Yeah.
And so as a result, I talked about leading indicators of growth. I'm jumping around here, but I just want to specify. Now
No.
I'm switching to leading indicators of growth.
Right.
Long leading indicators of growth. We have them for the United States. We have them for 21 countries abroad.
Mhm.
All of those we can put together. They are at readings. They're going down,
Yeah.
and they're at readings that we have only seen right ahead of or as global recessions are starting.
Mhm.
At the same time, the proportion of central banks around the world that are tightening is at its highest reading ever on record.
Right.
So, I mean, you don't have to be really steeped in this in economics and finance to kind of
Right.
figure out that that's not a great combination.
Right.
And as far as we can tell, that's continuing. There's That's the updated information. And so, you come back to the idea: is it a soft landing? The market is certainly hoping that it is. The
Mhm.
equity market. I don't think the other markets are, right?
Yeah.
The equity market is saying, "Oh, you guys, we see something different," or maybe there's something else going on with equity. I don't know. Maybe
Mhm.
there is a Powell pivot. He's going to damn the torpedoes, and we'll get back to inflation. That could happen,
Right.
right? You kind of have a choice. It's either you're going to deal with inflation, which at this stage is, it's hard to not have a recession and deal with inflation. That's like one path you can go. You could totally pivot and try to juice everything again, but then you've got inflation. So the really interesting thing now, maybe their instinct is to pivot, but the really interesting thing is that there's inflation. So now all of a sudden this instinct is, they can't follow it that easily.
Yeah. Mhm.
So here we are.
Yeah, here we are, and and I think this just like ties into a question that Fan brought up, which is, he's asking about the inflation trajectory in the next 6 months. And I think you were just touching on this, but do you feel like we're having a premature rejoicing in equity markets?
So it's hard to, equities are what they are, right? I don't want to say I'm smarter than equities. I would say that if equities are banking on a soft landing and avoiding recession, they could be disappointed. Okay. There's an instance of there being a recession where equities didn't care. It's a 1926-27 recession.
Yeah.
So there's a recession and they just blew through it. And there's also a recession right after World War II in 45 where they blew through, but I think that's a little more understandable. In that sense, there's a recession because you're switching the economy switching away from war, but everybody could see that and you
Yeah.
knew what was happening. So I get that one, but the 26-27, there's a recession and the stocks didn't really care.
Mhm.
Okay, so it's not impossible. I just think that my big if my condition is that if the market's looking for dodging a recession, all the data we have is like, I don't see it.
No.
That's not there. So then we go to inflation itself. And now I'm just going to forget about the markets, forget about recession, and talk about the inflation cycle. Forward looking data on the inflation cycle peaked. There's a 3Ps downturn in the forward data. That's good. Okay. Could be worse, could be going up. All right. If the Fed pivots, maybe it will.
Yeah.
Okay. But so far we've got a 3Ps downturn. The thing is, now remember back to me saying it went to a 33-year high.
Right.
It's not that far off the high. Okay,
Yeah.
so yeah, it just runs up and then it's coming down a little.
Yeah. Okay.
Okay, it's not like that. So if it goes like that, I would be like, oh, okay, maybe there is a way out of this. But I think this what people have talked about is the stickiness of inflation, right?
Mhm.
There's oil is I mean, there's certainly demand destruction for industrial commodity demand because of the global industrial downturn, global
Mhm.
recession.
Yeah.
But um and we'll see what happens with food. There's still issues there. It's still a little
Mhm.
tight. But the bulk of your stuff is goods and services. And goods have come down quite a bit, inflation, but they're still a lot higher than they were.
Oh
They used to
yeah,
be
definitely.
deflationary, okay? And now they're totally a plus and
Mhm.
they're to the upside. So um it's still the level of that inflation is still up there. Then on services, of course, the really big thing is your rent.
Right.
And there's no way, I think, to say that that's turned down. That's really sticky stuff. And so, uh, I'm trying to imagine, does the Fed say mission accomplished because they got a cyclical peak, but the level didn't come down very much
Mhm.
of inflation? Seems hard, right?
Yeah.
I mean, so I listen when they're like, "Hey, we want to go towards 2%." Well, we're doing that now.
Yeah,
But do you
exactly.
want to get to 2%, or is it 3%, or where do you want to go? Because we're a long way from that.
Exactly, yeah.
And
I
that's where your Fed credibility lies, right?
Yeah.
So do they want to be credible?
Right,
I
yeah.
think so.
I think people misconstrue this as like, bashing the Fed and like everyone just wants to like pile on them, but there are some like legitimate concerns that we can have about, their approach to certain measures. And I think that's like important to talk about. Um, Last question I wanted to get to is, we've obviously talked extensively about inflation and recession, but can you speak more to how, how certain cycles might interact with each other? So, for example, do you observe anything from what you do that might indicate that recessions and inflation behave in certain ways with respect to each other?
There's so they're related. Talking a little bit about our framework, right?
Mhm.
So cycles and growth, we monitor those on their own, and we have a very detailed way, long, short, and different sectors. It could be services or manufacturing or trade or construction. These are all cycles, many cycles approach on growth. Separately, cycles and inflation, they're related to growth. Roughly speaking, 3 out of 4 times uh, an inflation cycle will turn after a turn in growth cycles. Um, but we can't afford to be like winging it on a quarter of them.
Yeah.
So we have leading indicators specific to inflation. And then within inflation, we have overall inflation cycles. We have cycles in home price inflation. We haven't even touched on that, by the way. And that leading home price index has turned down. And home price inflation has turned down. And people tend to look at nominal, right? But real home price inflation may actually start to contract.
Right.
And that is a real piece of the wealth effect, like
Mhm.
ultimately what that's worth, that asset for you or for homeowners. And so that's something to watch. And so we watch home price cycle separately. And then a third cycle on inflation that we watch very closely is industrial price inflation. So not precious metals, not agriculture, but actual industrial prices. So energy and certain metals and
Right. Yeah.
textiles and things like that.
Mhm.
And where you can get a lot of good information. We used to publish publicly something called the Journal of Commerce. It's the old. it was like this predated the Wall Street Journal. Pretty much, it was like the thing you had to read, and then people switched over to the Wall Street Journal.
Yeah.
So this is like old stuff in the 70s and 60s, and so the JOC index was a composite index that we developed daily of sensitive industrial materials prices, half of which are not exchange traded. So that can be very interesting at times, because from a cyclical perspective, they move together, right?
Yeah. Okay.
And they totally do that, and we use it. We use information from it in our own predictive indicators,
Sure.
forward-looking indicators.
Mhm.
But every once in a while, when the market's like, trying to disagree with cycles and stuff, you could see the exchange traded piece kind of separate for a minute from the non-exchange traded piece. Now, the
Mhm.
non-exchange traded piece is tied right to economic activity. The exchange traded piece is tied to economic activity and speculators.
Right. Okay.
So it could be super interesting to watch that. So we look at those aspects of inflation cycles, and then the third thing we look at is cycles in the job market.
Mhm.
Uh, Many people don't know this, but Dr. Moore, again, my mentor,
Yeah.
was commissioner of BLS and
Oh.
did a lot of work with the job statistics,
Uh-huh. Yeah.
and including the employment cost index he created and all these different things. So again, the job cycle can also at times turn at different points than cycles in growth. And
Mhm.
we've seen the jobless recovery. We've seen recessions where jobs turn down a little after they started. That can happen. And so we have separate leading indicators of employment. The other thing that seems to be happening that I think is interesting on cycles. That now I'm talking not about the current cycle, but I'm saying, like, what's the shifting backdrop?
Uh-huh. Yeah.
One is that um, slowdowns relative to speed ups, the slowdowns seem to be getting a little longer relative to speed ups,
I see.
which may be related to a second observation, right? Which is that the pace of long term trend growth in the US, in developed economies, and in developing economies,
Mhm.
by and large, there's a couple of exceptions, is decelerating because you have the demographic slowdown. You're for with some exceptions, demographics are very much, the working age population is not growing that fast,
Mhm.
and in some cases shrinking. And productivity growth. Those are your two components of long-term trend growth. How many people are working, and are they getting more productive? And that adds up to long-term trend growth. I mean, we could goose the economy and pull demand forward and do all this stuff, but you can't get away from these kind of basic, simple components of long-term growth. How many people are working? Are they getting more productive? That's long-term trend growth. Is that growing or not? And basically, those numbers are coming down. Okay, that's the problem. You can go to an emerging market and throw in a road, and boom, you got productivity. That's a major productivity boost.
Yeah.
Put in some communication, you got all kinds of stuff. If they repave the road out here and it's smoother, I'm not sure how much more productive. It's better. Maybe I go a couple miles an hour faster. I don't know. But it's not like this game changer.
Mhm.
So when we look into productivity growth, which is extremely hard to predict, if at all, it's tough. It's tough. It's all kinds of stuff. How smart are you? Were you thinking of new things? Are you working faster? What you find is that it's a lot of stuff is related to capital investment. That's one thing you want to try to look at is, are we investing in stuff that's productivity enhancing?
Mhm.
And all the capital structure, like the big stuff, we're way down on investment. It's all old, and
Mhm.
we're not doing so good on it. Place where there is some good investment is in the technology side, IP and intellectual property and technology, and we are getting some capital investment there, software and stuff. But the thing is will that This is an open question. Will that make the working workforce more productive in aggregate? I don't know. I hope so.
Oh yeah, well, definitely.
I hope so, but the trend's going in the wrong direction, and everything's predicated on it going up, and it's going this way. So that's a longer term issue.
Yeah.
And again, we started off talking about fiscal and monetary. Monetary can't fix that.
Mhm.
I mean, maybe that's a thing for fiscal side, but it's very difficult to get stuff coherent there.
Yeah. I think it's
And then, the other thing is just population growth. In the U.S., and I'll finish on this. I'm sorry, but the U.S. Relatively speaking, we've got okay population growth. It's just under 1% or so. It's like
right.
it's pretty low, but it's there. But I think about 2/3 of it was legal immigration, which either because of policy changes in past years or with COVID kind of just stopped. So we're missing a couple million people in the workforce as a result of that, and that may be related, for example, to the low unemployment rate. And there's probably also a skills mismatch and all these other
Yeah.
things.
Yeah.
But there's a lot of interesting stuff. I think cycles have some important and valuable additions to the decision making process.
Yeah, I think that's a really great way to put a bow on this whole kind of situation. Uh, awesome stuff, Lakshman Achuthan. Thanks so much for taking the time. I really appreciate it.
Okay, Vishnu, thank you so much.
I hope you enjoyed that. For more content, check out the rest of the videos on my channel. And be sure to look out every Thursday for a new episode.